It's beautiful around here today. 75 degrees, constant sunshine, and light balmy winds. But it's not like this everywhere. Let's check in with our reporter, Tony.
Well, it was warm and sunny yesterday, but today looks like heavy rain, high winds, and golf ball size hail. Ooh, a Titleist. Whoa. Anyway, who knows what's coming next? Looks like there's going to be a lot of damage. Back to you, Janet.
Oh, well, I hope he has insurance. Insurance is a pretty dull subject. Dull, that is, until you actually need it. Then it becomes very important. Did you use the right agent? Did the agent use the best carriers? Were the amounts of insurance enough? Did you miss an exclusion that's going to come back to haunt you? Every board of directors knows that their association needs insurance, but I'll be willing to bet that very few know what types of insurance or how much coverage they really need. When it comes time to deal with the insurance, there are 3 bids on the table and the board picks one. Let me ask a few questions before you vote. Are you sure that the value placed on the common areas is correct? Have all of the insurable areas been included? Do you know all of the exclusions and how they could impact your association? Do you understand who really is protected under our fidelity bond? Do you know the areas your directors' and officers' liability insurance doesn't cover?
If you can't answer these questions, you better not be voting on that insurance just yet. You really don't want to wait until the first time you have a claim to find out whether or not you're really covered. Unless you have an insurance agent who specializes in community association insurance sitting on your board, trying to figure out all the answers to all the questions regarding insurance takes a lot of time and effort. Well, we're going to try and give you a hand by pointing out both the major and lesser known areas of concern.
First, check with your attorney to see if your state law places insurance requirements on your association. Next, in your association documents, there will be a section requiring the association to carry property and liability insurance. There may be specific requirements in the documents relative to the type of coverage and the amounts. Make sure you understand these and make sure you provide potential agents with a copy so that they cover all of the required areas. The documents will also spell out the common and limited common areas that the association is responsible for and must insure.
Property insurance is required to cover the property, either owned by the association or by the members of the association in common, and, in the case of condominiums, possibly parts of the individual units. You'll want a form of insurance that's termed either broad form, or all risk, or risk of direct physical loss. This generally provides coverage for damage or destruction of property from fire, vandalism, and other specified perils. It's important to know what is covered under the terms of the policy, and it's also equally as important to know what isn't covered. In fact, in every insurance policy, it's important to know what is covered in terms of both building structures and contents. For what perils or losses are they covered? What's excluded? What are the limits of the coverage? Who gets paid when a loss occurs? Who makes the decisions, and how are they made?
All too often, it's the failure to ask the questions and understand the answers that cause the problems at exactly the time you don't need them, when you're trying to solve a crisis. Tony, would you check out that crisis?
Sure. Wouldn't miss it for the world. There are are too many examples of problems that associations have had when they didn't pay attention to the questions. Major disasters like Hurricane Andrew that damaged so much of South Florida caused many of the shortcomings to receive national attention. But it doesn't take a major natural disaster to cause problems. It really doesn't.
With property coverage, you start with a property that has to be covered. Although your documents tell you the general areas that need to be covered, an inventory of the common areas and what they contain would be in order to make sure you don't overlook anything. Insurance will not cover items that are not included in the policy or are excluded. Once you know what needs to be insured, you need to know what it will cost to replace them. Original construction costs are the best place to start. Very often, however, those are not available, and all too often boards rely on industry averages and the best guess of the agent to arrive at a coverage figure. This is bad from both ends. If the amount is not enough, there may not be sufficient funds to replace the items, or if the estimate is too much, you'll end up paying extra in premiums, since the insurance will not pay out more than is needed to replace the item under the term of the policy. If you haven't done this yet, you probably should have an insurance replacement appraisal by a qualified professional to place a value on the replacement cost of your common areas.
There are two basic types of property insurance. One is based on actual cash value. This is the replacement cost minus depreciation, which means less than the actual replacement. And the more popular, and really the only one appropriate for a community association, replacement cost. This is the estimated cost to rebuild at current prices and with current materials of like kind and quality. This is limited to the policy limits. For example, $10 million, unless it's guaranteed replacement. Under this form, the policy limits are set only so that a premium amount may be established. But the insurance company will spend whatever it takes to rebuild, even if it exceeds the limit.
Here are a few things you need to watch out for. Look out for the term insurable replacement cost. This limits the policy to only certain items and excludes others, such as land, paving, heating and cooling systems, walkways, patios, underground pipes and drains, fences, landscaping items, and more. If the term insurable is used, please know what parts of the property are not covered. Do you smell smoke?
No. Yes. I'll check it out. Building ordinance coverage is one that's all too often overlooked. Now, if your association was built a few years ago or even more, and it's likely then that local building codes have changed. In a basic replacement policy, the cost of upgrades required by changes in codes is not covered unless this endorsement is added. Now, this may cover a lot of safety devices that have been added to building codes over recent years, such as smoke detectors, sprinkler systems, fire doors, or fire retardant materials, all of which would increase the cost of replacement construction. Oh, demolition coverage. Oh, without this endorsement, only the damaged portion of a structure would be covered for demolition, even if the entire structure needs to be torn down. What the? Is something shaking here? Oh no. Oh no. Oh my goodness. We could be talking earthquake here, folks. Oh no. There are three big exclusions: flood, earthquake, and hurricane damage. All require separate policies. You get some side benefits to these gifts of nature that are also normally left out of the basic policies, you know. Erosion and mudslides, damage from power failures, water damage from leaks or backups, failure to maintain the common property, and mechanical breakdowns are among some. Debris removal generally means only the insured debris, not something that's blown in from somewhere else.
You certainly brought enough of that debris back with you. The point here is not only do you need to know what is excluded, but other limits as well. Personal property is typically included, but only to a specified amount or percentage of the total. But that amount might not be realistic. Get an actual figure of what you need. Don't rely on a percentage. Does your association have something different from the normal association? A golf course, swimming pool, retention pond, docks, playground, etc. They will probably not be included in your basic coverage, but you need to be sure that they're covered. Inflation Guard adjusts the amount of insurance periodically during the policy term.
So what other areas should you be concerned with?
Coinsurance. This basically says that the association will be responsible for covering a percentage of a loss in return for reduced premiums. This should be waived in most cases. Deductibles. Make sure they apply on a blanket basis for all of the buildings covered. Otherwise, in a multiple building disaster, there could be a deductible for each building.
If you have any of these items, then you're going to have to deal with them separately. Boilers and machinery and miscellaneous mechanical machinery. Commercial vehicles owned or leased by the association. Glass coverage above the limits normally placed on the basic policy. Garage keeper, if the association owns a garage. And then there's inland marine coverage, which really has nothing to do with either marines or even water. Suffice it to say that there are a number of specialty items covered under this form, like valuable documents, accounts receivable if you can't collect your assessments, satellite dishes, tools and equipment used by the maintenance staff, and electronic data processing.
One of the problems that arises when a loss happens, particularly in condominium associations, is determining where the association's master coverage stops and the individual unit owner's begins. This is especially true when it comes to what are termed betterments and improvements, or additions and alterations. Often when a loss occurs, the association's insurer will pay to replace items not required in the documents. For example, those items that have been replaced or upgraded by the unit owners. Associations may purchase coverage for this at an increase in premiums, or suggest to owners that they include it in their own personal coverage. It needs to be very clear who is covering what, so that if a loss occurs, arguments and lawsuits don't start, and boards can avoid the claim of wrongful handling of insurance. That's about everything association does, creates potential liability, board actions or inactions, maintenance or lack of maintenance, recreational facilities or activities, and more. Associations are often the deep pocket when someone trips over a crack in the sidewalk or slips on some ice, and it's the association that gets sued.
Here you need to clearly understand what causes the policy to be activated. The terms you need to know are occurrence and claims made. An occurrence policy will only cover actions that are started while the policy is in force. A claims made policy is activated when the claim is first made. If you switch from one type to the other, make certain that there are no time periods that are left uncovered.
There should be a requirement that the insured has a duty to defend the association, but you should be aware that this gives the insured the right to settle any claim without your consent. It is important that the insured not require the association to pay any judgment or settlement first, and that it covers legal costs up front, not as a reimbursement. Areas to consider under liability include commercial auto, hired and non-owned automobiles, police and security guards, employee benefits, employment practices, umbrella coverage to increase the limit of protection, year 2000 problems.
Hi, Mike. Sorry I'm late.
Win, I just can't believe this is happening to me. It's been 4 years since I was on the board of directors for that condominium.
Sometimes you just can't get away from some of those sticky little things that'll come back to haunt you.
Yeah, but I mean, who could have known how much to set aside for reserves for roof and tuck pointing? I sure wasn't interested in investing a lot of money for the benefit of some future owner, and neither were any of the other board members.
I'm real sorry, Mike, but the summons is clear and specific. There was a fiduciary responsibility. Now, I've reviewed all the documents and I've communicated with the current association's legal counsel and the insurance company's claims representative, as you suggested. Now, the facts are there is no coverage. Not for defense, not for liability, not for judgments.
We had D&O insurance. What were we paying for?
Well, the policy covered the directors during the policy period, but only as long as any claims were also filed in that period.
So now I gotta pay for it. Now they want to stick it to me, right?
I'm afraid so.
Out of my own pockets. How could this happen?
This is not something you want to face after your term of office as a board member is over.
Now, if you look at your association documents, you'll probably see a section entitled Indemnification. This generally states that the association will cover the costs, settlement, and damages paid resulting from a settlement or judgment against you as a result of your having been on the board of directors. I bet you'll sleep better at night knowing this, huh? However, often this only kicks in if the current board decides to approve it, or if your action wasn't considered gross negligence. What if the current board decides to wait and see what the outcome is before approving the payment? You could find yourself fronting all of your legal costs out of your own pocket. Furthermore, the indemnification provisions usually don't extend to committees, other volunteers, or employees. Remember, anyone can be sued.
But you and the rest of your neighbors have done a pretty good job running your association, and so you'll probably never have to face the problems of being sued. Don't bet the house on it. Community associations are being sued every day for all manner of problems, real or perceived. Here are just a few of the reasons associations have been sued in recent years. Poor judgment in the conduct of the association's affairs, acts of bad faith, mismanagement of funds.
Failure to maintain books and records, failure to collect assessments, waste of association assets, wrongful termination, discrimination, breach of loyalty, failure to properly fund reserves, failure to maintain property and common areas.
Wrongly filed liens, libel or slandered for something written or said about an individual, conflict of interest, failure to obtain competitive bids, approving special assessments improperly.
Scary, huh? And it could be very expensive. At first glance, everyone gets upset when they see huge jury awards or settlements in liability cases. But often, that's only the tip of the iceberg. Look at what your association's attorney charges, and then imagine what the total bill might be if he spends a year or two defending the association and you in a lawsuit. Now, these costs can and have often run into the hundreds of thousands of dollars. This is not an expense that you or the association need at any time. The question becomes not whether an association can indemnify you, but will they? And can they afford to? This is not an issue that you want left for someone else to decide.
Maybe your state has recently tightened up the laws governing what directors can and can't be sued for. However, this wouldn't stop an individual from suing the association.
But you've got D&O insurance, right? So you can go back to sleeping well tonight. But remember our ex-board member? Not all D&O insurance coverages are created equal. If there's one policy that you as a board member need to know in detail, it's the D&O coverage that protects you personally. This is not something that you want to say, oh yeah, toss in some D&O coverage, will you, when going over the association's insurance portfolio with your agent. This one should be read line by line and explained thoroughly. All right, so what makes good D&O coverage?
First, make sure it covers everybody, the board, committees, volunteers, and employees, and not just the current ones, but also those that have served in the past. If you don't deal with the past volunteers, then any lawsuit against them could fire up the indemnification clause and cost the association money.
Is the association named in the definition of insured? Now, this covers the possibility that a lawsuit could be filed against just the association and not any board members. You'd still want the insurance to kick in and pick up the costs of defense.
Is there a duty to defend? Is the insurance carrier required to defend you and the association? You'll want someone who steps up to the plate each and every time they're needed. You don't want to have to pay the real cost first and then wait for reimbursement. Is there a date in the policy that says the carrier will not cover anything that occurred before that date? Don't leave prior board members and volunteers uncovered. Note the terms carefully that we covered earlier. An occurrence-type policy will only cover actions that are initiated during the period of coverage, and if that policy is no longer in force, it may no longer be a duty to defend. A claims-made policy activates the policy in force when the claim is first made.
What does the policy exclude? Now, this is always the heart of the matter. While you may sit there and say, we'd never do that, or, oh, that'll never happen here, Murphy's Law says that it probably will, and when you least expect it. You want the fewest exclusions you can possibly get. Today, you can get policies that do not exclude issues such as libel, slander, defamation of character, sexual harassment, discrimination, wrongful discharge, publisher liability and copyright infringement, prior acts, or having a developer on the board. Now, these are among the important ones to look for. Why? Well, let's look at publisher liability. Your newsletter editor reprints the association minutes and forgets to edit out the names of owners who are behind in their assessments. An owner whose name is listed sues you. So, you need to be covered.
Most policies will exclude coverage for illegal or dishonest acts. Bodily injury. A board member punches out an owner who then sues. Property damage and other items. Again, make sure you can live with the exclusions or that the coverage for them is not available anywhere.
As with all of the other insurance coverages we've been talking about, it's always good to make sure the carrier has an AM Best rating of A or better.
The key to any good insurance policy is no surprises. Because of your potential personal liability, your D&O insurance is one area you need to make absolutely sure you know exactly what is and isn't covered. Read it carefully. Have your agent review it a line at a time if necessary. Have your attorney review it. Do whatever you need to do to feel comfortable. You're not getting paid to sit on the board, so you definitely don't want it to cost you either.
Money has been stolen from associations. Treasurers have embezzled. Managers have created phony companies and invoices. And employees have stolen funds and items. Large, inactive reserve funds handled by someone with a need for cash have been real tempting.
It is extremely important that your association has proper controls of the handling of its funds. These controls should be spelled out in a formal resolution and followed closely. But you need to go one additional step. Anyone who handles association monies should be bonded or insured. Many states require this, as does the secondary mortgage market.
A fidelity bond is designed to protect the association against theft of funds or other dishonest acts by any individual or individuals named in the policy. This is usually an association employee or the association member who controls the funds. But this is also where you have to pay very close attention. Very often associations with management firms will rely on those firms having coverage on their employees. But this basically protects the management firm against theft by their own staff, unless the association is named on that bond. They wouldn't be covered if the employee stole from the association's account. So the association should always have its own bond, protecting itself, and not rely on a bond that's established to protect another entity.
An insurance firm issuing a fidelity bond will want to make sure that the proper financial controls that we spoke of earlier are in place. You'll want multiple parties involved whenever cash is handled or checks signed. The person recording receipts should not handle deposits. Checks should not be made out to cash. Movement of reserve funds should require a board resolution and at least 2 signatures. And you should have at least 1 annual outside audit. Work with your insurance agent to determine other methods of reducing risk and thereby your insurance premiums. We're going to briefly touch on workers' compensation. This normally covers losses from injuries to a person or persons employed by the association. Rates and benefits on this are determined by the state. Some states may allow for board members or volunteers to be covered also. Check with your agent as to whether this is permitted and what is involved. Not that you would have to, but the issue may come up.
The best way to control premium costs is to undertake a formal program of risk management. The goal of risk management is to protect the assets of the association by reducing the potential for loss. To accomplish this, the association should establish a formal program that includes identifying risks of loss, measuring the possible financial impact, developing a program to deal with the risk, and set up a program to monitor and control.
You're trying to cover 4 basic potential exposures: property, get a replacement appraisal; liability, arising from injury, property damage, or acts; income, are there non-assessment incomes that should be covered; personnel, fidelity insurance, workers' comp, and employer's liability should be investigated.
When you have the potential risks identified, then you need to develop a formal program for dealing with them. First, by risk control, and secondly, by risk financing, insurance. Most associations already do some form of risk control by repairing cracks in walkways, trimming shrubs for better views, adding security measures, etc. By carefully documenting your efforts at risk control, you can provide your agent with information that can be useful in obtaining better quotes from an underwriter. Since insurance is probably a major part of your budget, any effort in this direction is probably going to be helpful.
Part of a risk management program should be the maintenance of copies of key records at an off-site location. Minutes of meetings, financial records, copies of insurance policies should all be maintained with at least a 7-year history in a safe, secure location. A good risk management program should be in writing and adopted as a formal policy by the board. First and foremost, you want an agent with experience in handling your type of association. Is the agent familiar with your state law? Can he read your documents and understand what they mean? Can he help in developing a risk management program? Can he answer questions in a way you can understand? Does he try to fit coverage to your specific association or just pull some policies off the rack? What companies does he work with? Does he offer individual unit owner insurances that will not leave any gaps with the master policies? What organizations does the agent belong to? Does he have or is he working toward any of his industry's designations? Does he support your local community association organizations? What companies does he represent? Can they provide certificates of insurance to owners in a timely fashion? Can you talk to someone for whom the agent has processed claims? Check out all the references. How should the process work for selecting an agent?
Specifications should be developed that accurately reflect the association's insurance needs. They should include a copy of the association documents, photographs of the buildings and grounds, plat maps, your independent replacement appraisal, special sections on unique coverages needed, copies of any loss history, and copies of policies and procedures regarding risk management areas, such as how the funds are handled. Appoint someone to respond to agents' questions or requests for additional information. Requests for quotes should be sent out to the selected agents 3 to 4 months before your insurance anniversary date. Bids should only be solicited from a few agents, since they will often be going to the same companies for underwriting. The agent selected should be given an authorization to quote letter to a specific company. Don't sign blank authorization letters. Presentations should be given to the board or insurance committee with sufficient time permitted to thoroughly review the quote and have questions answered. And it's professional courtesy, by the way, to have only one agent at a time in the room making their presentation.
The board should carefully review the bids, paying particular attention to the ratings of the companies. Best ratings refer to the financial stability of the companies rated, and you should try to have your business placed with companies with an A-, A, or A+ rating. Why is that so important? Associations in Florida found themselves in deep trouble after Hurricane Andrew, when a large number of claims went unpaid because of the insolvency of the companies which carried the policies. That's not something you want to have to explain to owners whose homes are gone.
And when you find a good agent and good coverage, don't waste everyone's time by shopping him every year. If you face a significant and unexplained increase in an area, then by all means, renew the bid process.
The agent should be invited to a general meeting of the owners to explain the association's master policy coverage and, more specifically, to outline the areas that the individual owner needs to address with their personal coverage. The board or committee should work with the agent to prepare a communication to the owners providing this information. Now, most agents will appreciate the opportunity to talk to the owners. The agent should also do a mailing to the unit owners explaining the master policy. If you have a loss,
contact your agent immediately. A claims adjuster will be assigned from the company or companies carrying the pertinent policies. You don't have to accept everything this person says or does. An insurance policy is a contract. It's the association's responsibility to negotiate the best possible settlement. Yes, you can negotiate insurance settlements. Your agent will work for you, or you can hire your own public adjuster to negotiate with the companies. But remember, that will have a cost attached.
insurance is an extremely complicated subject, and we've only been able to touch on the basics. Hopefully, we've given you information that can be useful in obtaining the best possible insurance policy for your association. Remember, if you're not sure, ask. And if you don't understand the answer, get assistance. Insurance is too important an item to be left for a vote on the lowest price. We hope this video has provided you with a solid overview of what you need to know about community association insurance.